Hello, everyone, and thank you for taking some time to listen to our first investment update for the year. I was thinking back to last year. We were saying we hoped 2023 was slightly more boring than 2022, and as it turned out, returns were actually quite good in 2023, especially for global equities. But for most of the year, assets struggled. And why did they struggle? Well, they had competition. And what is the competition we were speaking about? That's 5.5% US short-term interest rates. So a lot of competition for risk assets. But what we saw was a strong rally in sort of the last quarter of the year, not only in South Africa, but across global equities as well. When I think back, it's kind of what we call the AI or the artificial intelligence rally. So as soon as ChatGPT got a bit of publicity, everyone jumped on the AI bandwagon, and shares like Microsoft and Nvidia were incredibly strong. The sort of second interesting theme in stocks was the obesity drugs. So there we're talking about two businesses like Novo Nordisk and Eli Lilly, which were incredible winners during the year. But we're far more interested in what the drugs' effects are going to be on other industries like tobacco and beer and food and snacks, etc. But clearly the thing that drove assets the most during the year was interest rates. And while it can be frustrating for us as bottom-up investors, almost any day if you told me people were just sort of looking at the speeches of every single Fed governor, every word they uttered, and that tends to move markets quite significantly. And what markets did do in the last quarter is kind of say, well, we think interest rates have peaked globally and central banks are going to have to cut interest rates. And by the way, they're cutting them at just the perfect pace that it doesn't affect the economy at all. And that's why we had a really strong last quarter. But when we look at the beginning of the year, some of that has already unraveled. Unfortunately, if we look at South African equities and we convert their prices into dollars, we're almost back to the levels we were at the peak of COVID when measured relative to global equities. I think that tells you two things. One, obviously the shares have been weak themselves, and it's not surprising given how slow the economy has grown, but also the currency's been weak. I'm sure for anyone who's traveled over the last year, when you go to America or Europe and you have to pay 30% more in euros and pounds, let alone in rands. So if we look at how the portfolios are positioned, they're positioned very similarly to the last 2 years. We have an overlay for a slightly higher world inflation, which means higher interest rates, an energy short world, and an increasingly divided world. And I think that increasingly divided world is something that's come through quite strongly over the last while. We can already see it, the Red Sea, ships are not going through there. They have to be rerouted past our office here, and that just adds to inflation as well. And then sort of the increasing tensions with China. I know it's something we've spoken to most of you quite often. And when we look at China, we can start to see the effects. Chinese equities have been a terrible place to be. And in fact, the Hang Seng Index has only been lower once since 2009. And that comes through not only in big shares like Tencent and Process, but it also affects Richemont, and it also affects, obviously, the commodities, because South Africa effectively digs things out of the ground and sells them to China. And so it's not surprising, the commodity shares have been pretty weak over the last while as well. So when we think about China, again, it's not saying whether the stocks are very cheap or very expensive. Even if we find them cheap, it's limiting the position size in the portfolio. The year 2024, I think when we look back, is going to be known as the election year. And why do we say that? Well, if you look at a study, Deutsche Bank just released a long-term study. 2024 is going to be the year where most people have ever voted across the globe in 1 year. I think it's well over 40% of the world's population is going to be voting this year. We've just had the Taiwanese election, which was important given the relations with China. We obviously got the big one in the United States of America. We've got India, the world's biggest democracy. We've got the European Parliament. And of course, we have our own election here in South Africa later this year. And I think, this year's election in South Africa is pretty important. And why is that? Well, we have a very high cost of capital in South Africa if we look at the level of our long-term interest rates, and we also have a very low growth rate. And unfortunately, when you put those two together, what comes out is a very low valuation. And that's why South African Inc. or South African domestic-facing stocks are trading on such low valuations at the moment. So one of those two things, or hopefully both of them, needs to change. Our cost of capital or interest rates needs to come down, and the economy needs to start growing. And it's also very important, the election, because we need foreign buyers in our bond market to consistently fund our fiscal and current account deficits. We need money coming in from the outside to fund South Africa. And that could lead to a big re-rating of many of South African assets. If we just look at how the portfolios are positioned, to conclude, as I said, very similar to the last 2 years, sort of underweight US stocks, underweight big cap tech stocks. We overweight Japan, overweight emerging markets like Korea. And I guess one of the big differences between us and our peers is we remain underweight South African long-term bonds. So thank you for listening to this update. We think the Balance Fund is well positioned to get through this year as what we call the sort of the year of elections. Thank you very much.